The health of the U.S. stock market on any given day depends on a number of variables, but the New York Times reports that lately it almost entirely hinges on the success of artificial intelligence and the companies behind this technology. As AI tech improves, so does their company valuations. The Times says that based on one J.P. Morgan estimate, 80% of U.S. stock gains this year came from AI companies. But the heads of some major tech and finance companies like Amazon, OpenAI, and Goldman Sachs have warned that these stock valuations are getting too high. And if they fall short of expectations, then, quote, investors will pull back and the bubble will pop, much like it did during the dot-com bubble in the late 90s. For more, let's bring in Evan Gorelick. He is the writer for the morning newsletter at the New York Times. Evan, thank you for being here. So yesterday, Fed Chair Jerome Powell actually talked about this, and he said AI is different from the dot-com bubble. But we have experts like Microsoft co-founder Bill Gates. He's saying we're already in the midst of an AI boom. So what are experts telling you?
Yeah, I mean, there are two theories of the case here. One is what Fed Chair Jerome Powell was saying, where you see these companies that are making a decent amount of money. They have some amount of profit, they have some revenue, but there's this other side of it where these companies have $13–14 billion revenue, but way more than that, hundreds of billions of dollars in investment. And lots of people look at that and say there's a mismatch. And that's what people are sort of worried about is, if the tech does not catch up with the level of investment, that eventually there'll have to be a correction, people will withdraw their money, and lots of people will lose a lot.
You write about something called the scaling hypothesis. What's that?
It's essentially the idea that as companies spend more money on computing power, on chips, on and electricity, and give it more data to produce more AI models, those models will essentially continually get better and reliably so. That's sort of been true in the initial sort of years of AI development, and they sort of look at that trend line and say this is going to continue. But lots of people are worried that it might not. And essentially for the AI investments we're making now to sort of make sense financially, it does in a lot of ways depend on those trend lines continuing. But some experts in the field, some economists and computer scientists worry that they might not.
So if AI doesn't perform as expected, what happens to the stock market? What happens to the economy?
Yeah, so a lot of people would lose a lot of money if it is a bubble and it bursts. And for context, we can look at what happened in the early 2000s with dot-com companies. We had lots of people investing lots of money in these internet-based companies, and eventually the profits just never got to where people hoped they would be. So people withdrew their money, those companies collapsed, and there was a recession. And this time around, the companies are much bigger. They are more profitable. They have more revenue. But not all the companies are profitable, and they're definitely not as profitable as investors want at this point.
All right, Evan Gorelick, thank you. We'll look forward to your newsletter.
Thank you.